strategically well positioned to service not just the Utica and the Marcellus, but also the Bakken in North Dakota.
We found a property at Warren that meets our business needs.
Just working with the chamber in terms of the marketing is invaluable.
The valley is a more vibrant community. Businesses are thriving. Now the city is really coming alive.
Once vacant buildings downtown are beginning to take shape.
There's a lot going on in the Mahoning Valley.
Most of the jobs being created in our area are permanent, good-paying jobs.
New companies are coming to town. Our local firms are growing and jobs being created.
Without the regional chamber, this task would have been very, very difficult.
The turnaround is part of a transformation spreading across the heartland of a nation. The area has benefited from prominent investments in manufacturing and developing Utica shale.
We've caught the attention of business people and the news media around the United States and around the world.
We created our first Manufacturing Innovation Institute in Youngstown. After the launch of the initiative in 3D printing, the world turned its attention to Youngstown.
We're mastering 3D printing.
News outlets like the New York Times have noted the revitalization that the region has experienced. The city is now featured in an average of 600 stories per year.
Our shops and restaurants are always busy. Our economy is growing.
Forbes magazine named the metro area as the 5th best in the country for raising a family.
Good, great job. Better than I've had in a long time. This was a huge step up.
The Regional Chamber provides excellent points of contact for throughout the expansion process.
The incentives offered to us really helped our investments.
Our project team worked side by side with the Regional Chamber team to find just the right fit here in the Warren area.
Then to be part of an organization that's growing in this area in manufacturing, I couldn't be prouder.
Seeing the revitalization that has occurred is so impressive. Our valley is booming.
Youngstown was the perfect fit. It's not just an affordable area. There are so many opportunities here.
Industry, business, commerce, and so they all make up a part of our community.
They're not ghost towns anymore. You actually have to go in reverse to find a parking spot downtown.
We've seen our area become a strong manufacturing and industrial center once again. There's a great workforce here.
Youngstown is leading an economic trend that should be encouraged.
It's just a special thing to come to work every day to a thriving organization that we're looking forward, we're looking at what's next. And to do that here in this area is phenomenal.
Good morning, everyone. I would again like to welcome you to the Regional Chamber's 2015 Economic Forecast Breakfast. I'm Marty Bushy. I'm a lawyer and partner in the firm of Manchester, Newman and Bennett, and I'm the chairperson of the Regional Chamber's Board of Directors this year. I hope you are all enjoyed the impressive and stellar work that's been done by the Chamber and the community to move us forward as it seems that we are doing. As Sarah mentioned, we have a very full and exciting program this morning. We've been having this event for about 10 years, and we've always brought in a keynote speaker, and they have given us an overview of the state of the economy. But we wanted to try something a little bit different this year. So we chose some very specific topics that are relevant to our economy and asked members of the banking institutions in our area to spend some time focusing on each of these. We're pleased that 9 organizations responded and agreed to participate today as speakers. They will discuss everything from the international economy and interest rates to the stock market, shale, and energy issues. I also would like to, at this time, thank our sponsors. We're eager to hear what our presenters have to say, but I would like to take a moment to acknowledge those who have sponsored this morning's event. Without their generosity and support, we would not be able to have these types of programs. So to Cortland Banks, Farmers National Bank, First National Bank, Home Savings and Loan, Huntington National Bank, Key Bank, PNC Bank, 717 Credit Union, and Talmer Bank and Trust, we truly cannot thank you enough for your presence here today. We are also pleased to have a second sponsor of our forecast breakfast today, particularly sponsoring the Regional Chamber's economic development portion of the program, and we welcome Phantom Fireworks. I want to thank the company president, Bruce Zolden, for the support not only for the Chamber events, but also for sponsoring the second annual Regional Chamber Night with the Youngstown Phantoms, which will be held at the Covelli Center February 13th. Of course, the Youngstown Phantoms hockey team, which is co-owned by Mr. Zolden and Troy and Afgaloni, will again be hosting the Chamber members, guests at the game against the Dubuque Fighting Saints. Hopefully you've already purchased your tickets or plan to be there, and if not, please see one of the Chamber members who will be happy to take care of you, or you can go to regionalchamber.com for more information. On behalf of the Phantoms, please welcome head coach and general manager of the team, Mr. Anthony Noreen, who will give us a preview of the game and tell us more about the players and the organization.
Thank you for having us this morning, guys. I'm the head coach and general manager of the Youngstown Phantoms. I think the first question we usually get is who are we? Who are the Youngstown Phantoms, and what are we trying to do? And I think the best way I could describe it is junior hockey, which is what we are in the United States Hockey League, is very unique to the sport of hockey. It's unlike anything else in sports. It is really an in-between step between high school, amateur sports, and collegiate hockey and pro hockey. So our goals are pretty simple. We want to bring in student athletes, guys that are looking to play college hockey, hopefully pro hockey afterwards. We want to provide an elite environment for them to train as hockey players. Our schedule is extremely grueling. We play 60 games, we play playoffs. Our players can be traded. Our guys are up every morning at 6 a.m. working out. They're practicing at 3 o'clock at the Ice Zone or at the Covelli Center every day. They're eating, breathing, sleeping hockey every day. So we feel we provide them with an elite training format so they could reach their goals in hockey. Just as importantly is them growing as students. Our players in our league, I should say, is the #1 provider of NCAA college hockey players. So we have a 17-team league. To kind of put it into perspective, each team has 23 players, and we put more players every year into college hockey than high school hockey does in the country, than any amateur league does in the country, than any junior league does in the world. This year, for example, we have 23 players on our team. 19 already have Division I college hockey scholarships. Over the last couple years, we've had over 60 players in my 4 years here that have gone on to Division I college hockey. So they're academics are also very important. We make sure they stay on top of their schooling. We have some players that are in high school. We monitor and make sure they stay eligible for the NCAA and make sure they're staying on top of their schooling. We also have players who are out of high school that we make sure if they want to take a couple courses before they go in, or if they just want to stay on top of maybe getting ready for their ACT tests or whatever it is, we stay on top of that as well. So that's equally as important, and probably just as, if not more important than those two things, is our community outreach. We want to make sure when our players leave here that they have a good sense of reaching out to their community, being active members of their community, growing up, becoming responsible young men. And very proud to say this year our players have already spent over 400 hours in this community, doing various outreach programs such as Hockey for Health, where we go into local schools and preach the importance of being active, getting out, staying fit, doing things outside of school, in order to be active. Also, we've raised over $20,000 for local charities through ventures we've done with them. So again, our guys being active in the community is extremely important. We will be out in the community even more this year. We hope that's something we can continue to grow. And if there's anybody here who has anything that our guys could help with or anything we could lend time, effort, we'd be happy to help if you want to reach out to our office. So again, we're trying to provide a format where guys can come in here, become better hockey players, become better students, more importantly, become better people, and when they move on from us in the Youngstown Phantoms, they represent this area unbelievably, and whether that's as a hockey player or whether that's as owning a business, being a lawyer, being a doctor, whatever it might be, we just hope that at some point they look back and are better people for having been here in our valley. So we hope that as many guys as possible can come out on February 13th. I know we had a great night last year in our chamber night, and we hope it's even better this year. You're going to see a great product on the ice. As I said, 19 of our 23 players are going to play college hockey next year. We also have 5 guys on our team this year that are projected to get drafted in this summer's NHL draft. So for the people that came last year, we had 23 guys on our team last year. 3 of them got selected last year in the NHL draft. So you're going to see high-level hockey. You're going to support a great group of young men, and hopefully it's a fun night at the Gavelli Center. So look forward to seeing you guys all on February 13th. Thanks again for having us.
Thank you, Coach Noreen. That was very informative, and we're all looking forward to being with the Phantoms that night and wishing you and your team all the best. Since we have so many experts with us today to address such significant matters, we're going to get right into our program and to give each speaker as much time as possible and hopefully ensure that the program concludes on time. We have decided to print everyone's bio in the program that's at your table. So instead of reading them, I encourage you to look at their collective accomplishments and highlights, as they are quite impressive. I would like to introduce all of our speakers before they begin their presentation. From your left will be Brad Hansen, Managing Director, Talmer Financial; Peter Bates, Manager of International Correspondent Banking and Senior Vice President, PNC Bank; Gregory LaMonica, Vice President of Corporate Foreign Exchange, Key Bank; John Augustine, Chief Investment Officer, the Huntington Trust; David Dastoli, Senior Vice President and Chief Investment Officer, Farmers National Bank; Gary Small, President and CEO, United Community Financial Corporation and Home Savings; David Lucido, Senior Vice President and Chief Financial Officer, Cortland Banks; Renee Lacher, Senior Vice President and Managing Portfolio Advisor, FNB Wealth Management, Investment Advisory Group; and attorney Robert Rutkowski, representing 717 Credit Union. And now, without further ado, I'd like to call on our first speaker, who will give an overview of the economic performance of the past year, 2014. Please welcome from Talmer Financial, Managing Director, Mr. Brad Hansen.
Morning, ladies and gentlemen. Morning, ladies and gentlemen. I did try this microphone earlier this morning, and I must apologize. I think it's broken. It makes me sound like I've got an Australian accent. Anyhow, I'll soldier on. When you're fully licensed, as I am, you have a gift, and you can actually foresee the future. But compliance, regulators, FINRA, the SEC won't allow me to tell you exactly what's going to happen in the future. But what I can do is go back and tell you what happened in 2014. So let's look at some of the factors that influenced markets last year. With the economic recovery in its 5th year, 2014 was the year in which Americans finally became confident in the economy and their financial prospects. Since March 2009, when the S&P bottomed at 666, the U.S. equity market has more than tripled in value, yet investors continue to appear reluctant to invest in equity markets, despite several short-term pullbacks 2014 was good for the major indices. The S&P far outpaced other broad equity indices with a gain of 13.7%. The NASDAQ Composite outperformed with a total return of 14.8%. The only problem with concentrating on the S&P for 2014 is the top 10 contributors to performance accounted for 28% of the index's gain, and the top 25 were responsible for 48%. Of the 13.7% total gain, 1.2% came from the largest single position in the index, Apple. This is why I'll concentrate on the Russell 2000. That's the line in red below. The S&P was in blue, for those who can't read it from that far away. Before I do, let's touch on global economic growth. The European Central Bank remained tentative in its approach to monetary policy, and Europe struggled through persistent deflation scares. The Bank of Japan launched a new aggressive easing program to combat its long-troubled economy, while Chinese growth slipped. Emerging economies were hit by falling commodity prices and slow global trade, as well as some inflation, credit, and liquidity pressures. This may be why investors viewed the United States as the best house in a bad neighborhood. So let's go on a ride with the Russell 2000, month by month through last year. Buckle up, ladies and gentlemen, this is going to get a little bumpy. An old market adage says, as January goes, so goes the year. Quite a volatile month. On January the 2nd, I learned a new phrase, polar vortex. Temperatures fell to unprecedented levels and low temperature records were broken across the United States. I found myself asking, why did I ever leave the Great Barrier Reef where I grew up? We also had a shocking drop in December job creation to the worst level in 3 years. But what sent the biggest shock through the markets was Vladimir, helping Crimea with their self-defense. January finished down around 5%. In early February, stocks rallied on Janet Yellen's monetary policy report of basically less money printing, but continued lower rates, and the House passed a clean debt ceiling increase. By the end of February, we were being told that the winter could be the coldest and costliest in memory. In March, we had a slew of bad economic numbers that were weather-related. Consumer confidence fell. The U.S. economy lost steam in the fourth quarter of 2013. Consumer spending and exports were less robust than initially thought. Factory activity slowed. Home sales fell for the 8th straight month. We also started to worry again about Russia as sanctions were placed, and it would lose hard currency from declining oil and gas prices. April continued to be choppy, but Yellen stated that rates would remain low for a considerable time. Consumer optimism brightens in May as economists lift the second quarter U.S. growth forecasts and housing starts rocket. June takes the Russell into positive territory again for the year as home sales surged to a 6-year high. To start the second half of the year, a group renamed themselves the Islamic State and proclaimed itself to be a worldwide caliphate. The markets reacted as there was a possibility of a near collapse of the Iraqi government and Baghdad could be lost. In August, U.S. economic numbers are sluggish and retail sales flatline. But we once again peek our nose into positive territory, but only briefly. From the beginning of September to mid-October, we have a 10% correction in the Russell 2000. As the US and European Union expand sanctions on Russia, stopping billions of dollars in oil exploration by companies including ExxonMobil and BP. September was also the first diagnosis of an Ebola case inside the United States. And honestly, we didn't handle it very well. In October, the Fed shuts off the printing presses. And believe it or not, the sky didn't fall in. The US trade deficit narrowed unexpectedly, due in large part to a record surge in petroleum exports. The IMF said that the global economy was weaker than expected, and once again, the US was the best house in a bad neighborhood. In November, US consumer sentiment climbed to its highest level in more than 7 years, and US jobless claims are the lowest since 2000. To finish the year, GDP expanded at a 2.6 annual pace after the third quarter's spectacular 5% rate. 2014 marked the sixth consecutive year of gains for the US equity markets. Accelerating economic growth, strong corporate earnings, and an accommodative Fed all helped push markets higher through the course of 2014. A major 2014 surprise was the massive decline in oil prices. Oil's price, as a true commodity, is affected by supply and demand. The major reason for the price decline has been a significant increase in supply, especially from the US, and expectations of lower global demand. Since its June high of $115 a barrel, Brent crude lost over half its value, falling to $53.45 a barrel at the close of the year. This makes me a bit nervous because as we've corralled the Russian bear into a corner with sanctions, now we're poking him with a lower oil price. Anyway, falling oil prices puts downward pressure on inflation. The combination of a boost to US economic growth and lower inflation is one reason stock prices rose and bond yields fell over the last couple of months of 2014. My last graph is the 10-year Treasury yield. Who in the room thought interest rates would have been higher by the end of 2014 than when they started? I certainly did. A combination of low inflation, weak global economic growth, and some deflation fears caused Treasury yields to fall rather than rise. The 10-year Treasury yield fell from 3% at the beginning of the year to 2.2% by the end of 2014, marking the largest annual decline in 3 years. QE programs were completed at the end of October. The Fed, citing improving labor market conditions as well as general optimism about economic growth in their decision to end stimulative monetary policy. The markets reacted positively to the endorsement of the US economy's health. Still have a little bit of time left, so I know at the beginning I said I couldn't tell you exactly what was going to happen, but I feel like we're a little bit closer now. So I will make a prediction. I'll predict to you in 2015 that the equity markets, the currency markets, the commodity markets, interest rate markets will trade precisely between their highs and their lows. But I'll leave it up to the other panelists just to fill in those details in between. Thank you very much, ladies and gentlemen.
Thank you very much, Brad. And now that we've heard the overview of the past year, the remainder of our speakers will be addressing their focus on presentations on 2015 and beyond. Here to tell us about the international economy is Mr. Peter Bates, Manager of International Correspondent Banking and Senior Vice President at PNC Bank.
Thank you. Sorry. Well, the title of my presentation is Another Year of Many Crises. And it seems like after doing this for international correspondent banking and managing country risk and credit risk for foreign banks, that every year has many crises. So the international function at PNC, we assist our customers in exporting, importing, or if they have investments overseas in brick and mortar. And this slide is just to give you an idea of the extent of what we have in terms of facilities to assist our customers. So I'm trying to, not that I want to go back into the past, but these are basically still in play, and they're still going forward. So we have the Eurozone crisis, we have this ISIS crisis in the Middle East, pandemic, and then Russia-Ukraine. On this slide about the Eurozone, I think the most important point is that I don't have to put the top bullet point being what happened in the last 8 hours. There was a period of time that was an important point. But basically for the Eurozone, the issue is there's too much debt, too little growth, it's structurally flawed, there's no easy political solutions. The issue with Greece now, I believe, most of the debt of the country Greece is owned by other governments in Europe. I don't believe it's so much of an issue for the banks in Europe or in the United States. The question with ISIS is, will it expand beyond Iraq and Syria? And I don't think it will, although that's not to say there couldn't be isolated incidences in other countries. This is Russia and Ukraine. This is the one that's taken up a lot of our time and continues to take a lot of our time in international correspondent banking and managing country risk and credit risk. I should say here, this is probably a good point to say that what we do is we manage all the credit and foreign country risk in the bank. And that's both to transactions that we ourselves are the primary risk taker, or where we have a secondary risk in terms of we have a corporate customer that we have a credit facility for, they may have a big investment or a big contract. We end up consulting on the issues that might relate to that. So Russia's been a big issue. The sanctions are taking a real toll, combined with the falling oil and commodity prices, has made a big difference. The exchange rates have been volatile and the ruble's been weakening. Their foreign exchange reserves are down. There's capital flight out of Russia, both by foreign investors and by locals, and GDP growth doesn't look very good. Yet the thing that's hard to comprehend is that Putin has great popular support there. It's hard to say which way that's going to go, but basically we're trying to be very careful about the risks we take there. Now, we cover a lot of countries for risk. We assist a lot of customers with different countries. I tried to pick countries that I thought maybe there could be a real change going forward. So, for example, I could have talked about the price of oil and what it does to foreign countries. As a general rule, our assessment on the price of oil going down, it's beneficial to almost all foreign countries. And the countries that will suffer the most in terms of the decline in revenue, foreign exchange revenue, can be divided into two groups. You have the countries like Saudi Arabia, United Arab Emirates, Qatar, that have massive foreign exchange reserves. They can afford to carry the lower price for a long time and have sufficient time to make structural changes within their own economy. But there are a few countries that the price of oil falling has a very severe effect on because they don't have foreign exchange reserves. So basically I tried to pick here countries that I thought would make a big difference. So now, these are really my opinions. So I think on the improving side, where we see a real difference or a real change in creditworthiness or country worthiness would be Egypt, number one. I think the politics are mending there. There's big money flowing into Egypt from other Middle Eastern countries. It is considered high payments risk in terms of what the rating agencies would rate it, but I feel much better about it. I think it's going to continue to get better. Lebanon, this is another country where they consider it very high payments risk. Most of that's because of the political risk and all the external players that try to affect what happens in Lebanon. But from my opinion, the Central Bank of Lebanon has an exemplary record of acting independently to preserve their foreign currency reserves, to make sure they honor their debts, to give confidence to the Lebanese community outside Lebanon that does invest in Lebanon. Cuba is an interesting one. I put a question mark here. The rating agencies considered actual default, which I believe they did after the revolution. Undoubtedly, the improving relationships with the United States is a positive, but there's so much we don't know that it's a real question mark. We don't know what their foreign debts are. We don't know what their foreign currency reserves are. We don't know how the rule of law is going to work in terms of foreign investment, etc. Then the next category I consider riskier. Algeria, there's a lot of political risk there. Price of oil declining is going to hurt them. And that there's an interplay between that and the political risk, because if there's less revenues, there's less jobs, etc. Thailand, you have the rural north versus the metropolitan south of the country. A lot of political pressure there. I don't think it's going to get worse, but there's always a risk of it. Pakistan, this is a country where we have had many customers do a lot of exports to. The risk there is that you have a lot of political risk. You have questions of ability to pay. So far as I know, they've honored all their debts. They honored all their letters of credit, but it's very tenuous. Then I think we move into the ones that are high probability default. Well, first of all, Venezuela with the issue of the price of oil. They don't have much in the way of foreign exchange reserves. They have a lot of political risk. There's questions about their ability to pay. This could be the year, or they're getting very close. Argentina, their unorthodox economic policies are really starting to make a difference in the ability of Argentina to perform on its debts. They are in technical default because of the holdouts on the restructuring of the Argentine debt in 2001, but there are more arrears on payments. I think this could be a year that could make a difference and really move it. These are some of the risks we look at when we're doing our country risk assessments. The first two are both short-term and long-term risks. So if you have an investment in brick and mortar in another country, that first category is very important, especially over the longer term. Balance of these I would consider short and long-term risks. And in our business, this compliance, well, actually our business and our customers' business, this compliance risk is an important point. We have to comply with sanctions. We have to comply with all the other points about know your customer, etc. And our corporate customers should do the same. We were sort of surprised at some of the questions that we were getting after some of the first sanctions had been in place on Russia for a couple of months on people that wanted to export equipment. I see I'm just about to use my time up. One other one that we always keep in the back of our mind relates to China. Chinese growth from 1993 to 2012 averaged about 10% per annum. Looks like we may be moving to a newer level of around 7% going forward. And there are risks there. So far, I don't think they're very high probability of actually coming to fruition. But we have an issue of the level of overall debt compared to the growth of the country. We have questions of the debt of regional and municipal governments. There's always questions about the bank asset quality, and there are a lot of banks in China. Right now, we kind of limit ourselves to the top 50, and when we get down to that bottom 10 of that 50, it gets hard to find good information. And we have the issue of a slowing real estate sales and prices in the face of an overbuilt environment. Oh, sorry, I guess I'm over. Well, thanks.
Thank you, Peter. Our next focus, foreign exchange, will be presented by Mr. Gregory LaMonica, Vice President of Corporate Foreign Exchange at KeyBank.
Thank you. I was going to ask how many people are actually involved in the currency market. It's a big room, and I'm not sure if you raised your hands I would even see you. So I'm not going to ask the question, but I do think there is some relevance for the entire group as it relates to business that you might be doing internationally, whether that business be transacted in dollars or in currency. And hopefully I'll give you some insight into some of the things you might be or might want to think about given the current environment. So just very broadly, a little bit about the market and some of the trends. The market, as per BIS, that's Bank for International Settlements statistics, in September of 2013, so about a year and a half, a little less, says that it's a $5.3 trillion market daily. A lot of money moving around the world, a lot of money moving around in an extremely volatile environment. The dollar itself has been in an upward trend against all major currencies, with the exception of the Swiss franc. I don't know if anybody has been following the news over the last 2 weeks, but the Swiss franc made a significant move, which caused their currency to appreciate by 30%, both against the euro and the US dollar. They essentially had been defending a pegged value against the euro of about $1.2 Swiss francs per euro. They dropped that defense of that rate. After defending it since September 2011, they threw in the towel and basically said this is not working. A lot of the trends in the market, and again, that primary trend of US dollar appreciation have been a long time in the works. I'll show you some charts that give a little bit of an illustration, but essentially the dollar has been an upward trend for, in most cases, at least 2 to 3 years, and in some cases you can go back and we are either at historical levels or levels not seen for perhaps 10 years. I think these trends are fundamentally based, as some of the other speakers mentioned, with respect to interest rate policy. The currencies by and large will chase, if you will, higher yielding currencies. Investors will place money, deposit money, if you will, in currencies that offer them a higher yield. And so many central banks around the world have been cutting interest rates. Our Fed has obviously, the question is, when are they going to raise rates? So we're on divergent paths. A lot of the volatility in the ancillary markets are certainly affecting currencies. China grew at 7.4% last year, which, as per relative historical Chinese growth comparison, that's failure for them. In fact, they even cut the reserve requirement yesterday to try to create more monetary accommodation. And then, of course, you have Dodd-Frank regulations, which have caused some people in the market who could previously hedge currency exposure to no longer have that capacity. Again, charts. I think they provide nice illustrations of movement. So this is the euro over the last 2 years. The severe downward slope since May shows a weaker euro. It's 20% weaker over that period since the end of May, beginning of June, where it peaked at $1.3995. It has since hit a low of $1.11. We have not traded at these levels since 2003. Recall that the euro was introduced in 1999 at a rate of $1.17.5. Again, it's a fundamental divergence in monetary policy, with our Fed ending QE and the ECB embarking, just announced in the last week and a half, on a quantitative easing program. And of course, Greece is back in the news again. They had elections last week. You've got a new party in place. They want to renegotiate their debt. Originally, they were stumping on a policy that for debt forgiveness, and they have backed off of that a little bit. But certainly, you can see the steepness of the downward slope over the last 6-7 months, showing how swift and severe the sell-off in the euro has been. Excuse me. Canadian dollar. I know a lot of businesses in the area do business with Canada. The Bank of Canada has been very transparent in policy, not just policy moves, but also statements. The currency itself has weakened by 25% since September of 2012. They have been very vocal on relative terms. They believe that their currency is still overvalued. Obviously, the issues in oil are severely going to hamper revenue growth. They're even concerned about energy sector seeing more layoffs. And so the interest rate cut on January 21 was actually a move that they called insurance. Keep in mind that typically we are the United States is Canada's largest trading partner, so we will, of course, at some point see Canada continue to grow more significantly than it is as the U.S. growth continues to tick upwards. The Mexican peso, I normally don't include Mexico as part of my slides, but I think it's relevant for the local Ohio groups. There's a lot of business going on with Mexico. Some companies have Mexican operations. The currency peaked in 2013 at a rate of 11.94. And again, there's that 20% weakness that we've seen since. Just last week, it hit 15.06 pesos per U.S. dollar. And again, this upward slope now, contrary to the euro, but the same as the Canadian dollar, the upward slope reflects a weakening of the Mexican peso. Similar to Canada, economic ties to the U.S. should eventually lead to growth in Mexico, but the oil situation is very important to them. Again, oil revenues are falling for Mexico. The peso is often influenced by what else is going on in the emerging markets world. So you can see a lot of volatility in the peso trading, not just as it relates to what's going on with its major currency partners, but also what's going on in the emerging market environment. And as I mentioned, Mexican operations, if you've got Mexican operations and the peso is cheap, relatively speaking, there's an opportunity for you to potentially lock in a hedge to protect some of your expenses down in Mexico. On this slide, I actually, you've got two currencies. I added the Japanese yen and the Australian dollar. I probably could have swapped in the British pound as well. But as it relates to Japan, Japan has basically been in a state of recession, and if it's not recession by definition, certainly no growth. At least for a decade. They've been fighting deflation for quite a long time. The Prime Minister, Shinzo Abe, embarked on a program that the world calls Abenomics back in November of 2012. And essentially it was a program to attack deflation and try to get some growth to show its face. Essentially, two-pronged approach, a weakening of the currency and quantitative easing. They have embarked on the QE program and not only from its inception continued with that program, but also increased the size of the program. The yen, just since 2012, January 2012, now this chart doesn't reflect that, but the yen was trading at about 76 yen per US dollar. In December, it peaked at $122 yen per U.S., and I might imagine that will eventually pick up again. It's an odd phenomenon with the yen in that volatility in the equity markets actually causes people in the market to buy yen. I've been doing this for 25 years, and I still don't see the logic, to be honest with you, but suffice to say that is something that takes place. So as we've seen in some cases with equities, a lack of continued growth in equities. We're trading below 18,000, but staying above 17. And so what you're seeing for the Japanese yen is a little bit more consolidation, so a little bit more sideways movement on the chart as compared to some of the others. With Australia, there's weak growth again in China, relatively speaking. That is a threat. A lot of natural resources are coming out of Australia and being shipped to China. So the Royal Bank of Australia continues to weaken the currency, both verbally and through policy. They cut interest rates yesterday. And again, you're hearing this all over the world. Everybody's trying to devalue their currencies because they're trying to protect the export sector. Finally, just in terms of what's going on in the market and how this relates to you, so there's certainly risks for exporters. If you're selling in US dollars, the price of your product has gotten more expensive. If you're selling in currency and you're receiving currency, you want to protect the value of that currency, otherwise it eats into your margins. If you're holding assets overseas, you may lose value on those assets. But of course, there are opportunities. So if you're importing, it's a great environment to be locking in hedges for, to lock in weaker currency purchases for the future. And if you're selling internationally in currency, selling in currency could provide you with a competitive advantage. I would urge you to speak with your bank providers about what's going on in the currency markets to see if your best practices are actually in effect, or maybe you could tweak things to potentially gain some competitive advantage from doing so. Thanks for your attention.
Switch over.
Thank you, Greg. We'll follow up that topic with a look at the stock market with our expert from Huntington Bank, Mr. John Augustine, Chief Investment Officer.
Good morning, everybody. Come on, good morning, everybody. You're still out there, right? Stock market. We're going to specifically talk about the U.S. stock market in this short presentation to y'all. Going to make a couple observations, then show you 3 slides of long-term observations about the U.S. stock market. All right. As Brad noted, stock market's gone up now for 6 years in a row. We've fully recovered all of the losses that we may have incurred during the Great Recession, and we've been in a period of relatively above average returns for the stock market. That's good news. We hope you participated. Secondarily, as Greg noted, strong U.S. dollar, U.S. economy doing relatively well compared to the rest of the world. So in the stock market world now, we can keep, at least at our shop, a majority of our customers' money at home. We don't have to ship it overseas for growth opportunities. Good news. Third observation, interest rates. We all know the ultra-low interest rates. The ultra-low interest rates are now, good or bad, forcing investors, long-term investors, to go to the stock market not only for growth, but for income now, as most stocks in the S&P 500 yield more than the 10-year Treasury. We don't know the bottom of the 10-year Treasury, but the lower they go, and if our economy keeps moving forward, as a result, the better opportunity and returns we're probably going to have from stocks. Now, the future. Trying to gauge now, is the stock market done? Have we done 6 years of returns? And basically we're going to flatline now or give some of them back. So we're going to give you 3 long-term observations. This chart is the journey of the S&P 500 since the 1920s. Notice it moves in a very distinct stair-step pattern. Now, if you stretch this all the way through this period, the U.S. stock market, on average, returns about 10% a year. So keep that number in mind. But there have been 3 periods that have been very difficult, flat lines, for the U.S. stock market. First in the Depression. Second was in the high inflationary period, 70s, very early 80s. And then we just went through the last one, and it was no fun. But the reason we show you this chart is about 2 years ago, something very interesting happened. On March 28th of 2013, The S&P 500 broke to a new record high. Far right, upper side, screen. Now, using history as a guide, now history in financial markets, it doesn't repeat, but it rhymes a lot. Using history as a guide, the last time the U.S. stock market did this was after World War II and in the 1980s. And after it broke to a new high, after an extended period of moving sideways, it went up for 20 years and went up tenfold. That's what history tells us. We don't know if this journey of the stock market is going to rhyme or repeat, but this was very noticeable to us when it occurred a couple years ago. It says there's upside to the stock market. Second observation, are stocks too expensive now? When you buy a stock or own a business, you're looking for an earnings stream from that. Then you try to value that earnings stream by something called a PE multiple. That's the formula for a stock price. This is the PE multiple of the S&P 500 going back to the 1950s. We're right at average. The stock market is arguably fairly valued. There are reasons it's low, there are reasons for high multiples, low interest rates, but there are reasons for low multiples, slow global growth, slow global economic growth. So it's right in between. For many of you in the room, you remember the period in the 1970s where we had single-digit PE multiples, high inflation. Then the 1990s when we went up to multiples nearly 30 times earnings. So our message to you here is stock market, our view, fairly valued. Now I have to look at the earnings growth of the companies I invest in. It's going to become more important. Third observation. 3 lines. Gold line. 10-year treasury yield, light blue. S&P 500, black. These also move in distinctive patterns. In our industry, what a lot of thinkers in our industry are starting to think is this period we're going through right now looks a lot like the late 1990s. Just substitute energy for .com. If that's true, then we have to look at the pattern of these 3 assets. Now, gold has gained a lot of favor, right? Since the Great Recession, even before that. The gold line there can go through very extended periods of flatlining. It now has moved underneath stocks noticeably. Interest rates will eventually go up. I don't know when, but in my lifetime, I'm betting I will get interest on my savings again from my bank. That's my big bet for today. These lines, though, are taking a distinct pattern from the 1990s. Stocks on top, black line, interest rates in the middle, blue line, gold on the bottom, the gold line. We'll see if this pattern continues to develop the way it did in the 1990s. Lots of things have to fall in place. But our point here was to say, 6 years of successful stock market. Can it continue? Can I keep rebuilding my 401k and my IRA? We think so. History would suggest, not guarantee, would suggest stock market fairly valued, but has an opportunity to move higher in a low interest rate environment, low inflation environment, where we still have profits coming from our companies. That's our presentation to you. Thanks for having us this morning. We appreciate it.
Thank you, John. We will next welcome to give us an overview of interest rates Mr. David Dastoli, Senior Vice President and Chief Investment Officer at Farmers National Bank.
Good morning. Thank you. If I can work the clicker here. Well, the reason I elected to talk about interest rates when the topics were presented is, of course, everyone's aware we've been in a historically low rate environment for an extended period of time. And there's been this growing consensus that, rates can only go up from here. It's inevitable. We can't stay this low for this long. And particularly long-term bonds, we hear back from a lot of our clients, are overvalued and a risk right now. We have a little bit of a different view from the consensus at Farmers. We think that with inflation dissipating, the global supply of bonds falling, interest rates of fixed income assets are priced appropriately, especially when compared to global yields. So not only do we think interest rates are unlikely to rise anytime soon, but we still think there's plenty of opportunity for rates to fall from here, or at least long-term rates, with some opportunity for rates to fall from here. One thing we have to be sensitive to when we talk about interest rates is interest rates mean different things to different investors. We're a wealth management shop, so we like to talk about the 10-year U.S. Treasury rate. As of January 23rd, it was a 1.9%, and this is important to us because this is what our most conservative clients can earn without any investment risk over an extended period of time. So that's kind of the baseline interest rate for us. The highly publicized Fed funds rate is actually targeted between 0 and 0.25%. According to Bankrate.com, average one-year certificate of deposit pays 0.23%. Average 30-year mortgage is at 3.8%, and the Wall Street Journal prime lending rate is at 3.25%. So I guess if you're a borrower, you're hoping you're wondering how long the good times will last, and if you're a saver or conservative investor, you might be wondering, am I ever going to get rewarded for my efforts again? How did we get here? In response to the financial crisis of 2008 and the worst recession of our lifetimes, the Federal Reserve Bank responded with a primary tool in its toolbox, the Fed funds rate, to aggressively cut short-term borrowing rates to 0%, and has stayed there ever since. Not only did this tool prove initially ineffective, therefore the Fed kind of doubled down with about $800 billion of purchases of long-term government bonds, which pushed long-term rates down and reduced the supply of global bonds available to investors. The thing we need to be aware of is that other central banks around the world have followed suit. Great Britain and Bank of Japan enacted similar programs, and just recently the European Central Bank announced their intention to repurchase over €1 trillion of long-term bonds, long-term European bonds. So again, we have this ever-shrinking supply of bonds and this continual downward pressure on interest rates. Of course, I would say it hasn't just been retail investors that have been, and consumers that have been coming to us and saying interest rates have to go up. It's inevitable. They've had plenty of company. In 2000 and at the end of 2013, Barron's did their annual big money poll. They asked the top investment firms on Wall Street, their chief economists, among other things, where did they think the 10-year Treasury would end 2014? At the time, we were at 2.6%, and this is kind of a who's who of Wall Street. This was Goldman, Merrill, Prudential, BlackRock, and the consensus view was that, well, the high end of the range was 3.75%, the low was 2.9%, and on average, the consensus was 3.3%. In other words, a rise in rates was inevitable. Almost a 30% rate increase in rates was predicted. Again, by the end of the year, we were at 2.23%, so really missed. So naturally, what did Wall Street do? Well, we doubled down. 2014, same survey. The consensus came down a little bit, a high of 3.5. The average came down from 3.3 to 3.0, and the low came down to 2.8%. But given the fact that we're now working off a lower base, the actual magnitude of the expected increase has actually gone up. So again, prevailing conventional thought is that, we can only go up from here. The question we've been asking ourselves is, if all of these firms and all of their clients are positioned for long-term rates to go up, meaning that they're probably underweight long-term bonds, where is the selling pressure that's necessary to drive long-term rates up going to come from? And we really don't have a good answer to that question. The other issue is inflation. All an investor in a 10-year Treasury really wants is to be adequately compensated for inflation. And the graph I have up here now is the historical relationship between the 10-year Treasury yield and the inflation rate. And you can see by the end of 2014, inflation practically dissipated to nothing, falling to just under 1% in the United States. And Treasury yields have performed very rationally, pretty much in line with inflation. In fact, we could even argue that at 2 times the inflation rate, Treasury yields are pretty generous right now. And it's really hard to make the case at this level that treasuries are overvalued. So it seems to be that they've performed very rationally and are in line with inflation and inflationary expectations. I really like this next chart. One of my colleagues referred to this as the global yield vortex. And what this shows is interest rates, 10-year bonds for industrialized nations around the world. It also shows some measures of their financial health or their ability to repay their debt. And we have debt to GDP and their unemployment rate. Of course, at the bottom, we have the global precedent of the historical precedent of Japan. Has been in a sub 1% rate environment for close to 20 years now. And then we have actually a country with prudent fiscal policies today. By today's standards, Germany with a debt to GDP ratio of 76.9% and an unemployment rate of 4.8%, so a reasonably strong economy, but not perfect, paying less than 1/5 to borrow for 10 years of what the United States government pays. And then if you take a look at some of the company we're keeping, U.S. at 1.67%, and these charts are as of January 30th, so rates continue to fall. But look at some of the company we're keeping with Italy at 1.59% and 132% debt to GDP and a whopping 13% unemployment rate. Spain with their 24% unemployment rate and lower borrowing costs to the United States. So certainly, if I'm a pension fund or an insurance company or a bank that wants to match longer-term assets to longer-term liabilities, and I'm a global investor, certainly on a global scale, U.S. rates look very attractive, and we continue to see demand for the 10-year U.S. Treasury as a reasonable expectation of getting repaid and the maximum level of return that I can expect to safely earn on my investments. Finally, we have the issue of the global supply of bonds. This chart is actually called global supply of duration, but it's really long-term bonds, the ability to extend my investments out over time. And in 2006, prior to the financial crisis, about 5% of global long-term debt was held by central banks around the world. That's fallen to about 80%. In other words, today about 20% of long-term debt isn't even available to the investing public for purchase. It's held by central banks around the world. And it's projected that by the time the Central Bank of Europe is done, we'll be down to about 70 to 75% of global supply being available, 20 to 25% being restricted. So we have this scenario of U.S. yields being relatively attractive, low inflation, and an ever-decreasing supply of debt. So in summary, we think with supply constricting, inflation under control, and U.S. rates relatively attractive, the Fed, there's a popular consensus today that the Fed will probably raise rates in 2015, although the other side of that bet is starting to fill up a little bit. But certainly the Fed may raise rates. It's more likely to be a one and done than a reversal of a trend. In fact, it's really just an opportunity to say, there's no practical reason for it. It's really just an opportunity to say, hey, our policies have worked. We came through the financial crisis, waved the flag a little bit, hopefully create a little optimism. But we certainly don't see it as a trend reversal. In fact, we see the yield curve flattening. And we think long-term rates still have some room to fall from here. So we're advising our clients to position themselves accordingly. Thank you.
Thank you, Dave. We will now turn our attention to the topic of mortgages and welcome insight from Mr. Gary Small, President and CEO of UCFC and Home Savings.
Thank you and good morning. I'm going to bring the topic a little bit closer to home at this point. How many folks out there have a mortgage? No, that's less than I would have expected, but I do think I'm in the right room. I've got plenty, so I'll cover for you. I would like to cover this morning the mortgage market here in the Valley over the last year, some of the variables that drive our thinking and the market's thinking relative to the mortgage market and what we see for 2015. Just briefly in the Valley, Columbiana County, Mahoning and Trumbull, we had about 4,500 units last year, which was a slight increase over the prior year, a couple 3%. Well over 90% of those sales were for existing homes. It was relatively flat as far as permits and so forth for the three-county market from 13 to 14. Pricing was up over 3% within the market. The national average was 4.6, but I think nationally things had dipped a little bit further over time than they had here in the Valley, so I wouldn't see anything negative about us being up below the average. And still a very affordable market. The average home went off at $85,000 last year, very much below the national average. A lot of volatility in that. I know for our units, we would be 50% higher than that. So take it for what it's worth. I think the main story there is there's a lot of great housing opportunity in the Valley, and it is very affordable. Drivers of the overall mortgage market from our perspective, number one thing out there is wage growth. That's been a little bit sluggish. It's improving, but it still is sluggish. Unemployment certainly seems to be our friend. We're below 5%. It is always important to be cognizant of the fact that the jobs that we've lost over the last 6 years at a national level were at $53,000, and the jobs that we've replaced them with are at closer to $45,000. So that to me says there's potential and there's upside, but you can't hide from the fact that there's lower income out there trying to find a home today. There's a new number that many of you might be familiar with that I didn't used to track with any interest until things got tough a couple of years ago, and that's a number called the U6, and the U6 is the combination of the unemployment rate with the folks that are out there that are underemployed, so they're working but they're not at their highest and best use. That number has been improving. It's been as high as 14-15% in the last couple of years. I think we're down to 11%, but by historical standards, 11% of folks who are either unemployed or paid so much less than their value that they would consider themselves in that state, that's a high figure. So again, potential for improvement going forward, but a little bit of the headwinds that we still see, actual wages and the number of folks that are out there looking for a better situation. Another bit of headwind is with regard to first-time home buyers. First-time home buyers usually make up about 40% of the market if you look at the activity over time. Now it's much more in the 25 to 30%, and that probably feels right when you think about the struggles that the folks who graduated in the last half a dozen years have had, getting established, getting in good core jobs that would lead them to their first spot. We are seeing progress, though. More folks kids are moving out of their folks' house. They're getting into the apartment market. We're also on the residential side as well in the apartment market, and we see a very robust activity there throughout Northeast Ohio, rents going up and so forth. That's not the permanent stop for these folks. They're on their way to a home. So again, I see that as a near-term upside relative to the mortgage market and home prices overall. Another number that I don't think anyone tracked prior to 2007, which was home equity and how many homes out there are underwater relative to the amount of money owed on them. Again, it's an improving figure, but here in the Valley, just a tick under 10%, and that's pretty consistent with the nation. So again, a number that prior to 2007, it existed, but it was a fraction. And what that keeps is folks can't move on up, if you will. And to a lesser extent, those folks that are above water, certainly we feel our home prices are not moving along at the pace they did, I know, in the 20 years before the crash came along. So we're making headway, but it's modest. Credit availability, I would say it's improving on all fronts for folks that are out in the market right now. The market certainly tightened up as was appropriate during the worst of it. But just this year, we've seen Fannie and Freddie Mae come out with the old traditional 3% down products. I know that's how I got in my first house back in '84. The FHA has changed some rules relative to mortgage insurance programs so that if you don't have 20% down, it used to be pretty costly to go out and get that on the market. They've came out with a program that makes it much more affordable for new home buyers. Jumbo mortgages, the rates on those got very much at a premium relative to non-jumbo mortgages, so this is stuff that's over $417,000. There's plenty out there. Those rates are coming down, and folks are making the move. And banks in general, and we would include ourselves in this, we had to touch the brakes 18 months or so ago when Washington created some new rules for us to think about relative to the mortgage market. And the net effect was, frankly, we stood down on anything, or many banks, I should say, stood down on anything that couldn't be sold into the secondary market, into Fannie and Freddie, which is the traditional route for mortgages beyond what you hold on your own portfolio. And over the course of the last year, we have come to realize that we can still do the business that we always did before those new rules came along. Some analysis had to come forth and so forth. What that means to all of us in the room is that, I'll give an example. If you're out looking for a mortgage, you may have found some hesitancy with institutions if your debt to income was over 43%. That's kind of a bright line test with some of these new standards. When we look back at the 10 years or so of history on how did we do on our underwriting of mortgages where we said yes to mortgages where the debt to income was over 43, we found those portfolios were performing as well, if not better, than those that were below 43%. And it sort of speaks to the quality of underwriting that goes on and the type of borrower that you feel good about lending that money to. Long story short, I think most banks in the marketplace are back feeling very good about doing transactions like that, which is good for professionals and small business owners and some folks that, again, probably tripped some of the unfavorable rules that Washington wrote for us 18 months or so ago. So it's good news for all. Even on the home equity, so you think about your home equity line of credit, during the most robust days, many of the folks in this room would have got a home equity right up to 100% of the loan to value of their house if they wanted it. But certainly 90% was available. That got curtailed, 75, 80% sort of became the rule. Over the last 12 months, you would have felt more banks moving in the, okay, selectively we're going back to the 90% loan to value, and maybe for certain very well-heeled clients, 95 and so forth. So there's probably an over-tightening as was appropriate, and now normalcy is returning to the market and the right opportunities are there for the right borrowers. From a rate perspective, as you've heard from our other panelists, it's never been better. 3 years ago, the first half of 13 was a huge refinance boom as rates had gotten to a low point that had never been seen before, and then they spiked right up about 75 basis points, 3/4 of a point, and everything was back to normal. And we thought, well, we'll never see that again. And sure enough, here we sit in February of 15, and we're back there. And the 10-year rate is fluctuating, which is kind of the benchmark for mortgage, is fluctuating between 165 and 185. A year ago this time, it was 285. And so what that means is very, very low rates. I would say that we're going to be in that low rate environment throughout most of 15 as we see it. Could they go down even further? Sure. So we're not trying to guess the floor. If you've bought a home in the last 2 years, take a look at the rates. And even if you refied back in the day, you may want to take another look because the opportunity is there. So in summary, I would say this about the mortgage market. The credit markets are improving. Products from the secondary folks and each individual bank out in the market are getting tailored back to better fit the criteria that fits the borrower instead of being such a cookie cutter approach. We're not all the way there yet, but I think everyone's made improvements. And although sluggish, we do see unemployment and wages moving in the right direction, and folks getting out and getting into the apartments, which is the next step on their way to home ownership. And so for our organization here in the Valley specifically, we would expect to put out probably $120 million or so in first mortgage financing in 15, and maybe another $50 million in home equity loans, which would be a good, modest, but good improvement over last year. And we had a pretty robust year last year. And I don't think our thinking would be too inconsistent about what the opportunity is in the market and what we expect from most of the banks in the room. So we're feeling good about where we're at, making investments in the business, and I think it will bode well for the Valley. Thank you.
Thank you, Gary. Our next focus is on asset management, and I'd like to welcome from Cortland Banks, Senior Vice President and Chief Financial Officer, Mr. David Lucido.
Thank you. nobody else has opened with this line, and I guess I just can't resist. I'm only here so I don't get fined. No, honestly, I'm honored and privileged to be here. I don't mean that, Tom. It was just a joke. Asset liability management is a function that's handled by the ELCO committee at a bank, the Asset Liability Committee. And it's really considered the most important committee, I believe, in any financial institution. It's charged with managing the risk on the balance sheet, and that's primarily in the way of interest rate risk and liquidity risk to a large degree. And if you think about a bank's balance sheet, it's customer driven to a great extent. I mean, customers come into bank with their deposits and they pick what deposit account they want, whether that's a checking account or a savings account, or if they're maybe investing it, they're looking at CDs and they're picking the term that they want. Do they want it in there 6 months? Is it 1 year? Or maybe they want 5 or 10 year CDs. And then you have the borrower on the other side of the balance sheet. The borrower's coming to the bank and need funds for whatever purpose, and you know, they select a 5-year loan or a 10-year loan. So all of those dynamics are not necessarily in the control of the bank. So the committee is charged with balancing that interest rate risk and liquidity risk, and it uses very complex models and spends a lot of time doing projections. And certainly we can't get into any of that in the 10 minutes that we have. So what I'd like to do is pick out a couple of scenarios that banks are going to look at in 2015. There are possibilities for any of us, whether you're a depositor, or whether you're an investor, or whether you have clients who you're managing investments for. So we'll look at something that's probably most likely is that interest rates stay where they are, pretty flat. We'll look at you know, how to look at investments and how to manage the investment portfolio with a rising rate horizon out there somewhere. Again, everybody seems to think it's inevitable the rates will rise. We just don't know when or how much. And then we'll look at a little bit of a different twist. In addition to liquidity and interest rate risk, we also have to look at credit risk. And there's one possible new kind of item to consider in 2015. So for the past several years, you know, we've been in this very, very low rate environment. And from a banking perspective, that makes it very, very difficult because, you know, we make money on margins. You know, we lend out to our borrowers, and we have, you know, interest rate yields that we make money on, and then we pay depositors. And so, you know, the bank has that margin. In this low rate environment, those margins have really been compressed. And that's been going on for an extended period of time. So the bank uses the investment portfolio really to kind of manage and try to level out the different maturities that are on its balance sheet, and at the same time try to make some money, and it does that with its investment portfolio. So when you look at where rates are and where they've been here in such a low rate environment, you really have to stay disciplined. You have the tendency to want to go long and chase yield and try to get decent return, but if you do that, at least if you weight too much in that component, you really end up underwater to a great degree if rates do go up. So you have to avoid, you know, sort of betting the bank on the long side. On the other end of the spectrum, by staying short, and which is what's happening, you know, throughout the country, a lot of businesses have a lot of liquidity because they're kind of just keeping it aside and waiting for good opportunities, you know, to make a better yield. Staying too short can hurt you from a profitability standpoint. Again, low-term bonds and at least short-term bonds are, you know, near zero returns, and you all are well aware of that with savings accounts and even interest-earning checking accounts. The returns are very, very low. So by waiting too much and putting your funds in liquid accounts and waiting for rates to go up to invest also is not a good answer. So what banks have been doing the last couple of years, and it seems to work fairly well, and certainly can work in any, you know, pool of investments that you have. And keep in mind that banks are not allowed to invest in equity, so the stock market is out of the question, so we're dealing primarily in the bond portfolio. But what's been working well in kind of spreading that yield opportunity across the spectrum is to use a barbell approach. And what that means is putting 50 to 75% of your portfolio in shorter term mortgage-backed securities and CMOs, maybe averaging 6 years or less. And those are amortizing products where you have a continual cash back coming into the institution, and that avails you to reinvesting it in higher rates if rates do go up. So by keeping it at least a portion of your portfolio short, you're kind of holding funds to being available for rising rates. On the other end of the spectrum, you should have probably 25% or so of your portfolio in longer-term bonds. Banks kind of like municipal securities. That also avails a tax-free nature on the return. So by putting, you can't overweight in that category, but obviously having municipals and at least a 25 to 30% weighting in a longer-term bond, gives you some yield that your mortgage backs in the shorter end are not going to give you. So that balanced approach is something that I think will continue throughout 2015 as rates continue to stay low. In managing that portfolio, you're always looking at the possibility of rates rising. So you want to be prepared for that. And something that we've seen on bank balance sheets the last several years, in the way of customers, kind of putting aside some funds that maybe are typically they've maybe had in a stock market, or they're maybe saving some money for something else. But we've seen what's been called surge deposits. Deposits in checking accounts and savings accounts have increased substantially over the last couple of years. To the extent, there's been normal deposit growth as well, but these surge deposits are looked at as temporary. In other words, when rates do rise and there are better yielding opportunities out there for customers, they're probably going to move the funds into other products or other avenues. So that's ends up to be a pretty significant risk that banks have to be aware of and have to look at, and regulators are requiring us to model that scenario when we do our projections. So if you think about it as a consumer, if you've been setting funds aside and saying, well, there's really nowhere else to put this to make any decent return, so I'll just keep it in a savings account, earning 0.05 or whatever it is today, it's not a very good return, but you're kind of waiting for a better opportunity. So if that opportunity does arise, there is a sort of a mystery out there as to how consumers will react, how fast will those funds move, and where will they go. So banks have been modeling the possibility of moving into CDs. If rates go up and you can finally get a CD rate that starts with a 2, that's pretty exciting. So people start moving their funds into longer-term CDs. And that's depending on the extent and materiality of that, could be a significant adjustment for banks to make on their balance sheets. Those funds have been parked for several years in these very low-yielding savings accounts and checking accounts. Moving into CDs at a higher rate really changes the interest rate profile of the institution. On the other side of the coin, when rates go up, the consumers could react and there could be disintermediation. I like that word. That's one of the few 7-syllable words I can actually say and spell. And that's referring to the funds actually leaving the institution, finding a better place, maybe being more confident in putting your funds in the stock market, putting into mutual funds, or God forbid, into a credit union. Yeah. So, sorry, Robert. So that's a liquidity risk. If the funds actually leave the bank, we're looking at modeling out, how we're going to replace that liquidity. It could cost us a few more bucks if we're going out to raise those funds in the wholesale market versus trying to, maybe having some of our own deposit specials to get some deposits in the door when that happens. So that's an important factor to model and to understand in managing a bank's balance sheet. The last item I'd like to talk about is a possible risk consideration, and it relates to the dropping oil and gas prices that we've had very recently. If it drops too low, it could affect the production of the industry and affect some of the revenues that some of the businesses rely on that are connected to the industry, and also can have effect on the municipal securities that I referred to that banks kind of like. I'm running out of time already. We worked with our investment advisor to look at the regions of the country that are highly dependent on oil or gas operations, and there was roughly 70 counties in the whole country. So something to be aware of is that, if their tax revenue shrinks and they're maybe not able to have as good tax collections in their counties or school districts, that's something that could inhibit their ability to service their debt and have an impact on their bond rating. So just something to be aware of. It's not a prediction, but just an awareness of a possible risk. Thank you.
Thank you, Dave. We're also glad to have an expert on hand to tell us what's going on in the shale and energy industry. Please welcome Renee Lacher, Senior Vice President and Managing Portfolio Advisor at FNB Wealth Management Investment Advisory Group.
Thank you. Is this working? Okay. Okay. Flipped a couple slides back. Sorry about that. Energy's been a big story this year. Certainly, almost everybody has spoke about energy before me, including my asset liability friend here even. He worked that in the conversation, and it has been a big topic. Oil prices, energy prices are one of the big surprises of the year. Essentially, since 2014, we traded in a range on oil of about 80 to 110 after hitting an all-time high of 140 in the Great Recession. This year, after peaking about 107 in the summer, prices have dropped almost 60%, which is pretty stunning. And we saw prices fall to the lowest prices since the midst of the Great Recession in the mid-40s. Although we've tried to find a bottom in the last few days, I'm not sure whether we've seen that. Oil trading has been very volatile in the past few days. Prices are down due to weak global demand and good production in the U.S., especially in Canada and North America. The energy revolution in America has allowed us to get more oil out of the ground, hard to get oil, at a reasonable price. And as a matter of fact, in January, the U.S., January 25th, week of, U.S. had record oil production. So our production is still ramping up. Supply is big. OPEC is refusing to cut production, perhaps in an effort to drive some of the U.S. producers and North Canadian producers out of the market because they are higher cost producers. Lower prices benefit some people, hurt others. They especially hurt countries that depend on high oil prices to fund social programs, especially Iran and Venezuela. As go oil prices, so go gas prices. Gas prices, for the first time this week, first time in 18 weeks, rose a little bit. The average price in America is $2.07. It's up about 2 cents, and many states are under $2. Lower prices clearly benefit consumers in America. We haven't seen them spend that money yet, however. It's been a little disappointing economically. We have seen a change in car buying, however. January's car sales, just released this week, showed that over 50% of autos purchased were SUVs, trucks, or vans. So Americans are taking lower gas prices as a sign that they can once again buy bigger cars, which is a little bit surprising. Natural gas, we'll move on to that. If we look at the trading patterns of gas, it's considerably different than oil. Natural gas peaked in 2005, long before the recession, at $15 a million cubic feet and fell to $1.96 in March of 2012. It hasn't made a new low in this cycle. Since 2010, nat gas is traded generally between $2 and $5, with the exception of a short spike about a year ago, and I'm referring to this as the polar vortex spike. Last year, my coworkers and I tried to incorporate polar vortex into as many talks as we could. It was kind of a game, so I got it in this time. Gas is now, yesterday closed about $2.67. When I was preparing for this, I thought it might be interesting to look at how natural gas and oil have traded relative to each other. The red line on the chart is oil, the blue line is natural gas. And we can see from 1998 through the recession, the Great Recession, nat gas was relatively expensive compared to oil, but that trend was reversed in 2009. And to quote Boone Pickens, perhaps part of the reason that was reversed is because the cheapest natural gases in the world is in the United States. I looked at the prices recently, and they're off their highs in Europe, $9.83 a million cubic feet. In Japan, it's over $13. So natural gas in America is very cheap, largely dependent and a result of the discovery of what some have termed the Saudi Arabia of natural gas in New York, Pennsylvania, Ohio, West Virginia, in the Northeast. The discovery of the Marcellus. The United States Geological Service estimates there are 84 trillion cubic feet of natural gas in the Marcellus. The Utica, located below the Marcellus and in Ohio especially, has estimates of 37 trillion cubic feet. The Utica's interesting because it not only has the dry methane gas, but contains natural gas liquids and unconventional oil reserves. The border between the wet and dry gas is in western Pennsylvania. Most of the Marcellus in PA, and it's very thick, the Marcellus, particularly in northeast PA, is only methane. The wet gas has more value due to the natural gas liquids that are included in that. And we have a young portfolio advisor who works with us, who used to work in the gas industry, and he provided me a couple of these slides. The gas in the Utica, about 30% of it, a well produces wet gas. The largest component of that is ethane. I'm not a chemist, which is not as valuable, but propane, isobutane, butane, pentane, and crude oil are also components of the gas liquids. Almost all of the gas liquids, besides ethane, trade in line with the price of oil. The uses of the gas liquids are wide-ranging, not just heating homes, powering power plants, but transportation, industrial, residential, commercial. They're used from things as simple as plastic bags that we use every day to antifreeze and gas additives and other things. This is a Chesapeake chart that he gave me, and it shows the composition of the oil, especially in western Pennsylvania and Ohio. The green is the oil window, represents where there could be oil. Oil's much easier to transport and requires less infrastructure than does gas. The light pink is wet gas, and the dark pink is dry gas only. So if we look at the development of the Marcellus wells, this is a chart from the people at the Penn State Marcellus Center for Outreach. It's interesting because this is going to show us over time how the wells have been drilled. First well was drilled in 2004, first Marcellus well in Washington County. The Ohio wells are relatively new. They started about 2012. At the time of this chart in November of 13, there were almost 3,200 wells drilled in the Marcellus and Utica. Most of the Ohio wells are Utica wells. Most of the PA wells are Marcellus, and especially the ones in the eastern part of the state are dry gas. Now, the video this morning was extremely impressive. I was very interested, and you must all be very proud of what's happened here. And we look at the benefits of shale in our local economy, and we can see they're powerful. This is a chart of unemployment by county in Ohio, and it's from 2010, 4 years ago. Please note that the dark colors are bad, the light colors are good. This is from November of 2014, and we can see a stunning difference in unemployment, which I think is perhaps the most important measure of economic activity particularly local economy. Some information from the Ohio Department of Jobs and Family shows some great results. Ohio's unemployment rate right now is lower than the state average. It's 4.8, national average, I'm sorry, it's 4.8. The national is over 5. The 9 counties that directly benefit the shale, if we look at the trend in their unemployment, it's down 66% from January of 2010 through November of 2014. In January of 2010, those 9 counties had an average unemployment rate of 14.8%. That right now is 5%. That's unbelievable. These are also good jobs. The wages, according to the same Ohio Institute, for all Ohio industries are $45,200. Ancillary shale is $61,270, and core shale $71,547. Not to mention all the other businesses that get spun out of the gas industry. It's boom to steel. It's a boom to restaurants, hotels, and other things. What's the future? Lower prices clearly are bad for future drilling, especially if it's expensive. And I know there have been some, just heard last night in the news, local layoffs. Most experts believe the real vulnerability is to the oil-producing states, especially where they drill oil that costs $60 a barrel or over to get out, where they break even. There's a lot of dispute on that, but some slowdown could be seen in the Marcellus. However, in the long run, the Marcellus and Utica are high performance and very attractive fields. They could serve to result in less imports from Canada, which we still import from, and produce some exports to Mexico, especially from the Texas field. There's also some demand drivers with gas that are very important. The average emissions from gas are much lower, so many coal power plants are being converted to natural gas, as well as large trucks on the highway are converting. Companies like UPS, Waste Management, FedEx, even ships and rails are planned on being converting. And I'm over my time. They stole this quote that in the video, but just a quick note. I'm from Williamsport, Pennsylvania, where the drilling started a little sooner than here. And the things that have happened there are stunning. It's like watching the economy grow in front of my face. And I saw this quote and I laughed because the first time I drove downtown in Williamsport a few years ago, when everything is now full and busy, and I had to look around for a parking place, I was really annoyed. And good luck in the future. Hopefully the low prices will be moderately temporary and won't affect the gas production in this area and Pennsylvania and all of our regions. Thank you.
Thank you very much, Renee. And last but certainly not least, we'll close our speaker portion of the program with a look at banking regulations with Attorney Robert Rutkowski, representing 717 Credit Union.
Rounding third and heading home. Might have pulled it out. How about this one? Oh, that's better. All right. Top 5 banking regulations for 2015. How's that for finishing your day? I imagine we have some compliance people in the room. I love compliance people. I mean, they're the first people to go to jail, right? It's a big burden. It's a big burden. But so very briefly, what's hot? And you can't talk about compliance without talking about our friends at the CFPB, the Consumer Financial Protection Bureau. They are the 800-pound gorilla, and they're headed up by our old friend Richard Cordray, who used to be the Ohio Attorney General. The first thing I want to talk about is the truth in lending and RESPA changes. And, we're going to talk about 2 forms, again, very briefly. They won't let me go through the H-24 and H-25 in great detail. So all I can tell you is that right now you're getting a GFE, a good faith estimate, and a HUD-1, which is a follow-up estimate. It tells you how much you pay for your mortgage, right, your closing costs and things. And the CFPB decided to change that, and I believe it's August 1st of this year, that's going to go into effect. The reason it makes the list is because, well, it sort of is a microcosm of the whole thing that the CFPB is doing. They have decided to change many, many disclosures that bankers and credit unions give to their customers and members, with the thinking that if people have better disclosures, then they'll make better decisions. Of course, that assumes people read disclosures, but you get the idea. The loan estimate and the closing disclosure are greatly changed. The thing that you really need to remember if you're involved with lending at all is that it's going to change what you can change by way of costs, what you promise them in the loan estimate, and then what they pay in the closing disclosure. There can't be much difference. And there's things that currently that can be changed that will not be able to be changed going forward. So that, along with many other, I guess, I want to say intrusions, but it's, I guess, effects that the CFPB has had on mortgage lending, that's sort of, I guess, the canary in the coal mine going forward. And, you know, we'll see if the CFPB is going to continue to have carte blanche. There's some people in Congress that would like to change that a little bit. But, you know, with the mortgage lending, they have made great changes. Now, with respect to collections, there's a lot going on with this. I think most people in this room are concerned about the originator side, you know, writing the loans. And the Fair Debt Collection Practices Act doesn't, as of right now, apply to you so much. That could change. I think that perhaps the CFPB would like to make it applicable in many ways to originators. I don't see, though, putting out my crystal ball, I don't see them doing that in 2015. I do see, based on these little things we get, the advanced notice proposed rulemakings, that they want to focus on the accuracy of the information that you give to people that collect your debts. They want to focus on the disclosures that collectors give to consumers. They want to shift it really toward almost a customer relations model with respect to debt collections, as opposed to a, you know, beat on them until they pay model. And, you know, whether that's effective or not, we'll see. But while I do think the Fair Debt Collection Practices Act, if they had their way, they would make it applicable to originators. I don't see that happening in 2015. Now, this is, I suppose, I think maybe the most interesting of the lot. Truth in savings. And when we talk about truth in savings in 2015, we're not talking about savings. We're talking about overdraft services. And some of you might know what that is, but basically, it used to be when you'd write a check, if you wrote a check for more than you had in your account, it would bounce. Along came overdraft services. Now they'll cover it and charge you the fee that they would have charged you to bounce the check. So why is that under truth in savings? You know, the bank is lending, giving you money, charging you a fee. Why is it not lending? Well, the interest rate for an overdraft service transaction would probably be over 100%. And some institutions are limited in what they can charge, so you can see how they sort of bootstrap that in there. I'm going to have to start talking in my compliance nerd voice in a minute. I realize I don't want to get too far afield, but here's where it affects you. And this is what upsets Richard Cordray, is the $25 pack of gum. You go in, you're at the drugstore, boy, you could use some chewing gum. So you swipe your debit card, and you didn't have the $1.25 for the pack of gum. But the bank and David, they're very happy to give you the money for that pack of gum and charge you $25 for it, okay? That's overdraft services, and Richard Cordray hates overdraft services. And he's been, I have some quotes here. I wanted to put 20 pages of slides in it. They just didn't think it would fit in 10 minutes. If you want the slides, I'll email them to you. Just ping me. Are overdraft services causing the kind of harm that federal consumer protection laws are designed to prevent? It's sort of circular, but you can see that they want to ensure the market for consumer financial products and services is fair, transparent, and competitive, and consumers are empowered to take more control over their economic lives. And this translates into very close scrutiny into overdraft services. Overdraft services do provide, however, banks and credit unions with substantial fee income, so it isn't something that they would like to see go away. The Home Mortgage Disclosure Act, some of you will never encounter HMDA beyond the 30 seconds I'm going to talk about it in your lives. HMDA requires banks and credit unions to ask questions about lenders in the mortgage arena that you're not supposed to be able to ask, and to record information that you're not supposed to be able to record. Not for making a lending decision, what race are you, how old are you, but for government purposes, to record that information, okay? So in HMDA, they're expanding it. They're looking at more, 37 new data points, okay? And the word was that they actually wanted to start doing HMDA on auto loans. Well, they have to change the name, though. I mean, it's the Home Mortgage Disclosure Act. It's Home Mortgage and Auto. It's pedantic. I'm sorry. But I guess the thing that scares me in this is that the HMDA reports give examiners key information on other things like fair lending requirements. So if the data that the financial institutions are being required to record for government purposes is being expanded, and that's being looked at with an eye toward fair lending, you're sort of using HMDA as a tool to punish financial institutions. Just my take. And speaking of fair lending has been something that the CFPB has been focusing on a lot, and that the federal government has liked to expand. And so they've identified some things they'll be looking for. They'll be looking at, obviously things like redlining are prohibited, right? But if you classify your loans as prime or subprime, that mere classification internally to you may be a focus point for an examiner going forward. The fact that you might have some subjective lending products where the loan officer actually has to maybe make up their own mind about the lending process as opposed to using a matrix or a very rigid lending process. Or if the employee gets incentives to make a particular type of loan. A lot of these types of incentive programs have been attacked, made illegal by some of the changes to the mortgage rules by the CFPB. But from a fair lending perspective, anti-discrimination perspective, that's also going to be a focus point in 2015. The mere use of brokers, the use of brokers for a significant part of your credit operations will get examiner scrutiny. And I think that that's beyond what we've seen before. And so it will be something that to look out for in 2015. So I guess to wrap up, will the CFPB continue to be a major factor of change in 2015? Probably, maybe not with the new Congress. Look at mortgage lending, collections, overdraft services, HMDA, fair lending. Those are the areas I see the CFPB being particularly active in. What do? Allocate the appropriate resources to compliance. Not too much. You can spend $1 billion in compliance and not be perfect. The appropriate level. Cooperate with regulators, work with counsel as needed. It reminds me, the post office had a commemorative stamp featuring famous lawyers for a while. They had to cancel it, though. People couldn't figure out which side of the stamp to spit on. All right, folks, thank you very much.
I again extend an appreciation to all of our sponsors for their support, to our presenters today for all the valuable information they provided to us, and to all of you for your attendance and your continued support of the Chamber. Thank you very much.